Hello and welcome to Gold Rush, our special coverage on gold, the yellow metal that has soared to an unprecedented $3,500 per troy ounce, boasting a remarkable surge of over 30% in 2025 alone. This meteoric rise isn't happening in a vacuum. Volatility in equity markets and an escalating tariff war are shaking up global trade, pushing investors towards this timeless safe haven asset amidst lingering economic uncertainty. Gold's allure remains stronger than ever, captivating both seasoned traders and cautious newcomers. So as gold sits at this dazzling peak, the obvious question is what's next for investors and can this upward momentum sustain? Should you continue buying gold or buy even now? To speak on this, we're joined today by Suvankar Sen, MD and CEO of Senco Gold, Tejas Shigarekar, Senior Tech Analyst, Commodity and Currency at Angel One, as well as Naresh Agrawal, Private Investor. Suvankar, thank you for your time this morning. And let me actually start with your take. You know, logic would dictate as gold prices are rising, people would be more and more hesitant to come to the store and buy jewelry. Is that what you're saying?
So see, what we have been looking in the last 2 weeks, Akshaya Tritiya is next week. So that is one of the auspicious seasons that we always have, and consumers are keen to buy something. But because of the higher gold prices, consumers are coming, but the ticket sizes, or rather the quantity of gold, is something that is getting impacted. So value terms, if we really look at it, everything will look very positive, and there will be a lot of growth because gold itself from a year-on-year basis by more than 30%. But if we look at the volumes, I think consumers are still digesting these high prices and they are coming, but within their budgets. So that is one aspect of it. And the second one is that the old gold exchange of it. So those who have weddings in the family, or there are consumers who are wanting to make the best out of these higher gold prices, are bringing their old jewelry into the stores and exchanging it for the new ones, which is a little slightly higher in terms of the quantity. So if they bring in 10 grams, they will buy something worth 12 grams. So this is another phenomenon that we are seeing at the stores in such prices.
Right. So, Ankar, a follow-up on this one, when you're saying that, yes, they're coming to buy in terms of their budgets, does that mean there will be an impact in terms of volumes if you have to look at this quarter? Because one, you are talking about Akshaya Tritiya. Two, there is shopping happening right now ahead of the wedding season that will come in yet again. So how is the impact that you're going to see in terms of volumes and in turn, in terms of the financials?
So in terms of value, what we are seeing, it's almost, I would say, we're close to the month of April. We will see a value growth. But in the last 15-20 days, because of the price high rise, we are seeing an impact of 15 to 20% in terms of volume. So yes, volumes will take a hit. And what we are hoping and expecting is that if the gold prices corrects a little bit, that will give some energy and boost to the consumers now that they have seen the higher prices, and if it comes down and corrects a little bit, that will again automatically give a boost to the consumers. And the wedding season continues to remain. We have May and June as a peak wedding season before the non-wedding season starts in the Q2. So looking forward that if there is any correction, and the gold prices have corrected from the highs, it had gone up to $3,450, close to $3,500, and today it is at around $3,320. So I think that correction will be helpful. And if consumer sees that the prices are stabilizing in such levels, they will start coming back to buy for the Akshaya Tritiya.
I want to understand from your perspective also as a jeweler, which scenario is more profitable in a scenario where the prices have gone up as much as they have? I'm assuming that you will have a certain amount of gold inventory that you held for a period of time. You're probably not keeping low inventory, right? So from that perspective, if you're utilizing your existing inventory, is that better? Or is it when a customer comes to your store and says, I have this much gold, exchange it for me and make another set of jewelry? Which is better operationally for you?
So operationally, we are always happy if the gold prices are stable. A little bit of increase of the gold prices year on year is good because that gives confidence to the consumers that this is a great asset, and no matter what In crisis times, it can move a little up and down a little more, but year on year, it is moving in a marginal levels, and that's the best thing to happen, because as a jeweler, we are making money out of the making charges and not out of the increasing gold price. These are kind of windfall gains or losses. And depending on the jeweler to jeweler, inventories are hedged. Someone is hedging 100%, someone is hedging 80%, someone is hedging 60%. So therefore, based on the hedging mechanism, those who are hedged less, they will tend to get a little higher in terms of the capital gains of the increase in gold price. Those who are a little hedged more, they will get a little lower kind of a profitability because of the in movement of gold price. So personally, I think it is always good to have a more the footfalls, more the cash flows. Everything looks very stable, because for us to plan for the future is also very important, right? So if the prices are too volatile, sometimes your planning goes for a toss, and you need to always be on your toes trying to figure out that, yes, the right kind of inventory and the right amount is there always at the store. Plus the fact that with this increase in gold prices, we're continuously innovating that we need to give lighter gold weight jewelry. So what used to be 25, 30 grams today has to come within 20 grams. So 15, 20 grams. Wedding jewelries have to be lighter. That is one more thing. Another good part, just, out of all these challenges, is that the diamond jewelry sales have also picked up, because that is made in 14 karat and 18 karat jewelry, studded with diamonds. So I think consumers for their personal consumption are now seeing that, yes, now that the gold prices have gone up so much within their budgets, they can now buy diamond jewelry or platinum. So that is another good part that might add to the profitability for the company.
So there are various perspectives to what is happening with the gold rush. One is, of course, from the gold jewelry perspective, which Mr. Sen has given us very well. Naresh Kataria also joins in on our conversation. And let me get your perspective as well, Naresh. You've been speaking with us here on NDTV Profit on how bullish you are on gold prices. Now the question is, and there's a raging debate right now, that have we reached the top? Are those who looked at $4,000, $6,000, being overtly optimistic, or will you see a cool off the moment things settle like they have in the last couple of days?
Yeah, my view is that one, it has run up too fast in the near term. So gold is now short term stretched. It is 25% above its trend of 200-day moving average. But the key aspect I'll consider is whether it's a bull market like the 2000s or the 1970s. I think that's the key difference I would want to analyze. Because the 70s bull market was driven by central banks, and the 2000s bull market was driven by retail and HNIs. And this time, I think the central banks have taken the lead. Gold bull market was much stronger in 1970s. Of course, it did have a lot of corrections. So there was a correction in 2006 of 20%, 30% in 2008, and even a 40% correction in 1974, 75. So maybe a breather is due, but the factors, which is the central banks trying to de-risk from the geopolitical risk of their central bank reserves, I think that's very much on.
Okay, so the de-risking factor is gone. Does it mean that the rally is stalled for now? This is why we wanted Tejas on the show today, to get a technical perspective on it. And Tejas, I'm going to ask you about silver also in a bit, but right now just gold on the charts. How high is high? Are we going to see a higher price point?
Yes, good morning, everyone. See, on the technical part, whenever we see the 1 lakh amount on the screen, the people are just keep cautious when they are expecting to trade into this area. As we see now, always the silver also, it's have the edge to cross the 1 lakh point. So whenever it's reach up to that level, it's getting sustained and volatility comes, and again on a month-on-month basis is not able to be crossed sustainably above the 1 lakh point. So when we see the gold also reaching up to that, which is a very cautious point when people are looking towards invest into the gold, they are just worried about how they can invest in a physical market. So always see the international cues, where exactly is coming through and how exactly is impacting the overall economic numbers. So definitely the Fed is took some other intention of to keep easing on those points. And finally, it will help the stability for the full employment also, as well as the dollar, it impacting on this higher level and keep rushing out the higher points. And again, when we see on the technical part, there is a DMA, 100 DMA, it's at 98, which took exactly the support, and yesterday it had the bounce back from that level. And broadly, the gold not able to be sustained on the higher level about the 3,500 and took the barrier on the higher side. And then again, it's pressurized from the higher level, and right now is reaching up to the 3200. So almost there is a support area when we see the on the technical immediate support at $32.20 and the targeting from the 9 DMA, and again immediate support around of $31.45.
Okay. I also want to talk about the relationship between gold and silver, and it's described, gentlemen, you will all know about this, but it's described as a gold-silver ratio. And what you look at is that 1 unit of gold is equivalent to a certain number, or 1 price of gold is equivalent to a certain value of silver. So if it used to be 70 back in the day, but as things stand right now, it's actually above 100. So if gold is at $1, you're talking about silver, or rather, sorry, explain this. If gold is at 100, silver is at 1. So that's how it works, right? Right now, it used to be 70, which means that the gap between gold and silver has widened quite considerably. In this market, Naresh, would you suggest that you should book some profits in gold and move to silver?
So how I see it is that gold is a pure monetary metal. Silver is a monetary and an industrial metal. So gold-silver ratio used to be 16 50 years back, 100 years back. It used to be 1:16. Even the peak in 1980 was at 1:16 ratio. Gold peaked at 800, silver peaked at $50 in 1980. It's below that even now. More importantly, the current bull market is driven by central bank buying. And I don't see any central bank buying gold. El Salvador and one more country has announced buying Bitcoin a little, but I don't see any apologies, no central bank buying silver. So all are into gold, and central banks are pushing gold. So I think gold is showing signs of geopolitical stress, de-risking, which central banks want to do. And of course, retail also now latching on to gold. Silver only has retail going for it. I don't see other triggers. So I'm not sure, I don't analyze silver that closely, but I think the triggers which are there for gold, I don't see them for silver.
So, Naresh, I have a follow-up on this one. I mean, Alex was talking about gold and silver. Let's look at the Sensex to gold ratio then. You know, I mean, usually, if you see currently as well, we are in that bracket of around 0.86, and the long-term average has been around 0.96, if I'm not mistaken. Does this mean that gold is then overvalued as compared to equities? And if so, your equities are still the best bet at this current point in time, taking the overvaluation of gold into consideration?
So that's a good point. People miss the relation between gold and Indian markets. At a more broader level, gold going up, I think, is good for India and Indian markets, is how the relation has been. We don't have data for 70s. Actually, in 70s, gold went up 16, 17x in US, but US markets struggled. But the last major bull market, which is 2001 to 2011, Indian markets did very well in that period because India has a big stock of gold. Indians have a big stock of gold, almost equal to our GDP. So gold going up does give a positive wealth effect tailwind to the Indian consumer or the Indian savings bucket. So I think gold going up, I would say, is rather beneficial for markets. And the data I've checked is whenever gold goes up 25%, and if you had invested in markets, small caps give not better than average returns when gold is up. So rather than competing gold versus markets, I'll say gold going up is a positive tailwind for Indian markets.
You know, at the end of the day, and we have Naresh, Tejas, and of course Mr. Sen also with us. At the end of the day, people watching right now are looking at all of the conversations about how those who invested in gold or did SIPs in gold or did gold ETFs turn out to be smarter than equity investors. Does that situation still exist? I'm going to come to Naresh Kataria first on that question. Maybe it's not a straight up gold or equity, but is this still a good time to start or continue your investments in gold?
So I'll first again step back And I'll refer to analysts who are saying now gold and Indian markets do equally well over long term. And I think these analysts or investment advisors are opportunists because gold doesn't do very well long term always. If you check 90s, gold was down 30%. The decades of 91 to 2001, gold was down 30%, and markets did very well. It was up 5x. Even 2011 to 21, gold was flat, $1,700 to $1,700 for 10 years, but markets were up 3x. Since Nifty was up 5,000 to 17,000. So, of course, gold has its own tailwinds, own factors which work for gold. And right now, it is the central banks trying to de-risk their reserve assets. And of course, I also believe, I spoke on the channel last time, that there may be a short position in terms of leasing, which happens in London and New York, and that will have to be covered eventually. So the example is a gold metal loan which Indian jewelers take. The source of that gold is usually deposited custodial gold lying in one of the depositories in London and New York. So the tailwinds for gold have to be analyzed, and I think this looks like a structural move for gold. Of course, it can correct. As I mentioned, even in the 2001 to 2011 bull market, gold corrected 20% in 2006 and 30% in 2008. So we better be prepared for volatility, which is how any markets behave. But we need to analyze for the long-term trends, and I believe the trends are very much in place to push gold higher.
So should you buy or not, Naresh?
I think it's a simplistic question. I can't give you a very direct answer, but I think there is some sense to have gold in one's portfolio. I'll just again give you a still broader picture. The current setup, which is Brent down, interest rates down, and gold up, that's a very, very sweet spot for India, because Brent down brings down our forex commitments and interest rates. Interest rates themselves are down. Gold going up gives a wealth effect. This combination is not available for too many countries, and gold itself has a far larger role to play for India. So again, I would not say equities or gold. Gold has a role to play, VB, but it is stretched. It is 25% above 200 DMA, which is where corrections usually happen. So if I was not allocated to gold, I'll wait for a slightly better entry point to allocate gold. But if what allocation I have or any investor has, I think we should just ride the bull run.
Hold, but don't buy. You know, Naresh, we're all about the simplistic questions here. And we hope to give our viewers simple answers, because that's what people want to know at the end of the day. That's what we're all here for. Tejas, I'm going to ask you that same question, and then I'll come to Suvankar as well. Buy gold right now, even at these levels? Yes, no, maybe?
On the technical part, there is a correction expected. As I mentioned earlier, also it's a psychological level, 1 lakh point. So people are very cautious about how to invest, where to invest. And when we talk about it's a physical market, definitely there is a demand. But on the how exactly the tariff going on in the international market, how they're taking the step, the essential, I said, they are allowing from the China. And again, they're taking another step to just easing out, again, looking forward the interest rate cut, the full employment also to be not should be harmful. So these mandatory assets had to be looked forward, and it will impact the dollar index. Again, we are if taking the support at 10 EM at $98 in a dollar index, it will take the bounce back, and it will reach up to the 102 to 104. So it will impact to the overall gold prices, and we'll see the deeper connection around of 5 to 10% from the here on. So we're expecting the buy on dip, it will be the better solution.
Buy on dip. How do you look at this, Suvankar? I mean, you can't give advice on whether you should buy gold or not, and probably your advice will always be yes, please buy gold, because that's what I sell. But in terms of prices going, you said Akshaya Tritiya, if people are, shoring up for a big occasion in their family or even for investments, how would you look at the investment perspective?
So, I'll talk from my personal level that, when gold prices were at 75, 80,000, we thought that, the prices are quite high, and we couldn't imagine that the while we can all talk of prices will go to 1 lakh rupees, but we never imagined that it will go so fast. But then, it has gone and it is going, right? So I would suggest that as an investor, you have to get into the market to, like meet SIPs or in a very kind of a staggered manner, keep buying. We will never be able to catch the lows, and, we'll never know which the highs are. So you start buying little. If there is a correction, you should buy again. And that's how I think we also are doing our best to ensure that at every level you are buying gold. It should be a part of your portfolio. And that's the way to look at it. And silver is another very good commodity along with gold to buy. And I think that is another thing that investors should surely look into along with.
Naresh, what you were talking about allocation, a lot of the advisors that speak to us talk about a 15% allocation towards gold. And of course, there's no one-size-fits-all solution. You're talking about allocation towards equity, towards fixed income in a good portfolio. And if at all you don't have that 15% allocation, I think the point that you were making is very good. In that, don't see this red-hot rally and think, oh, I'm missing out, so I should go and buy right now. I'm just wondering how you buy the gold that you own. Is it primarily through ETFs? And in your opinion, is that the best way to invest in gold?
So one is, before I come to how I buy, again, these allocations, people are talking 10, 15. I'll just caution you and everybody else. Most of them have latched on because gold has done well. I don't think they are coming to gold because gold will do well, because no one really has an idea, frankly. The factors moving gold are far more complex, but people, that's how investors behave. Analysts behave, or the advisors behave. They latch on to an asset which does well. So I don't know whether it's 10 or 15% is right at this stage. On how I buy, till some years back, we had far more options. We had SGBs which were extremely attractive. They are no longer there. We just have to hold on to what SGBs we have. There was one more very good proxy to ride gold, which was gold finance companies, because they do well when gold, they used to do well when gold goes up, because their NPAs come down and they have also better business and operating leverage. But RBI has tightened a lot of rules on NBFCs which give you gold loans. So primarily it is SGBs, it is gold Bs or the other ETFs. But I also have a slightly more outlandish take on this. I think if the challenges geopolitically and a scramble for physical metal plays out as I fear, then I think even some physical gold may actually be prudent to have.
So Naresh, clear question. Would you buy gold or silver or any of the precious metals, or would you advise buying a jewelry company?
So I have a problem with jewelry companies in the sense, of course, India's gold imports are kind of flattish for the last several years, and I think the price will go up, so obviously their sales will go up. But most jewelry companies are hedged, and I have a problem with that setup, in the sense, as the price goes up, they pay a mark-to-market losses on the hedges they have, either as a gold metal loan, or if some of them have even hedged on MCX. Of course, they'll realize those gains when they sell the gold to customers. But I don't think are direct beneficiaries of gold prices when gold goes up. And as I told, I have actually a big inhibition of, if there is a melt up in gold, it would create big issues for cash flow management for dwellers who have entire inventory hedged.
Naresh, thanks for that one. So in fact, let me go to Senko on this one. How are you looking at this, Suvankar? What would your opinion be on what Naresh is saying? Because inventory management becomes crucial, hedging policy becomes crucial over here, and in turn your cash flows.
See, hedging, as I said, that, some people are 100% hedged, some are 80, some are 60. And the cash flow, management is the most critical aspect to manage in such bull runs and when the prices move up. But as a listed company, which is dealing with gold, quarter on quarter, if there are any volatile movements and the prices come down, then it will unnecessarily impact the balance sheet. So I think that yes, in the long run, the bull run is there, but it is a wise thing, because ultimately as a jewelry company, we are going to make money out of the making charges that keeps going up with the increase in gold or silver prices. and not so much on the gold, value that goes up. So yes, Naresh ji is right from that perspective, but risk mitigation and risk management in a downward market is also very, very important. And we do a balanced hedging for the same. But yes, the point is that it's much like the gold loan companies, jewelry companies, or those who are dealing with gold, rather than buying the physical commodity, those who are utilizing the gold for businesses, I think that is a good way to look at investing in gold as well.
Give us some more color on buyer behavior at this juncture. I know we began with that question, but I'm wondering about whether or not people are going out and buying bullion. What percentage of sales currently accounts for that?
So there are investors in the market. People who are not keen to buy gold maybe 3 years back is now more excited to buy gold and bullion. So for us, the bullion percentage is around 5%. Jewelry still continues to remain a major part of your sales. And as I said, that weddings is one aspect of it where people have to buy no matter what the prices are. And from a personal savings point of view, people are moving towards lighter weight jewelry, sleeker weight jewelry, because that is something that they can buy within their budgets. But, for us, if it is 5%, for someone else or bullion dealers, that could be a higher percentage of 10, 15%. But there are people and buyers keen to buy the commodity, and there is this fear of missing out amongst a lot of investors that we can see.
Right. So, I mean, everything that glitters, whether that is gold or not, is what everyone has to really guess from here on, because with the rates that are rising, I mean, usually, what we've seen is gold has become an investment at times of crisis. But when you're betting on economic growth, that's when the equity picture comes in. So it's a very tricky situation that India is sitting on right now as well, along with the world. But thank you so much, gentlemen, for joining us on the show to have this fantastic discussion, whether gold or equity, or whether gold or silver. Thank you, Naresh. Thank you, Tejas, as well as, Suvankar as well, for joining us on the show and sharing.